Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. And on today's show, we have with us a true veteran in the multifamily syndication business, Mr. Gene Trowbridge. Gene is a founding partner of Trowbridge Law Group LP. Gene's law practice concentrates on the syndication of commercial and investment real estate through both debt and equity. Gene has represented over 625 clients in this area of practice. As a former syndicator who for 10 years raised investor capital through the broker-dealer community, he is able to communicate with his clients on both the technical and practical aspects of state and federal securities law. Gene, truly an honor to have you on the show.
Thank you, Tim. I'm pleased to be here.
So, your background in this business is long and diverse. So, I was only able to touch on it a bit in my intro. But on this show, we really like to get down to the details of how you got started on your journey. So, please tell us a little bit more about yourself and what brought you into the multifamily or real estate space more in general.
Sure. Thanks. I came out of college and I went right to work selling commercial real estate. I had an accounting background, but I didn't want to be an accountant. So I took a job being a broker back in Minnesota with commercial real estate. And I did that for a while. And somewhere along the line, I bought a couple single family houses like many people do and managed them myself and didn't like that very much. So I found an apartment building that I didn't have all the money myself to buy it. And Tim, that's where every syndicator gets started. They find a piece of real estate and they don't have enough money. So I grabbed three friends that I'd gone to college with. The four of us bought this apartment building, and I'm on my way into the syndication industry. I sold my houses. I went strictly into syndication, actually moved to California. And when I hit the road running in California, it was full time as a syndicator. And I did a lot of stuff. I did a couple apartment buildings, I did a mobile home park, but I settled on the fact that I didn't like management very much. So I settled in on building self storage facilities. I teamed up with a contractor who could pour cement. We did cement slab and cement built up walls in self storage. And then we sold them when we got to 40, 50% occupied. And so we did 32 of those. And that was really my syndication career. And so it takes me to 1994. In 1994, something was happening in the industry. And that year I sent out over 2,000 K1s and I had about 850 investors. And it was just too much for the size company that I had. And I didn't want to make that company bigger. That's not my style. So I went home to my wife, and in my family, all the best decisions are made sitting at the kitchen table. And we sat down and I said, I'm through with this. We've made plenty of money. I've got an income stream maybe for the next 5 or 6 years without working. I'm going to go to law school. So I headed off to law school and passed the bar when I was 45 years old. And the only reason I went to law school was to become a syndication lawyer. And so I opened my own practice. I've never been a W-2 employee. I opened my own practice, and 30 years ago, I started my career as a syndication attorney, and I'm still doing it. And doing a lot of business, always taking on new clients. And today, Tim, as you probably know, maybe 70, 80% of our business in the firm, there's 6 of us, is multifamily business. We're doing an awful lot of multifamily work because that's been the asset class that's been favored, probably since 2008, I would say. So that's where we are. So interesting.
Yeah. So what you're telling me is it's not too late for me to go to law school. become a lawyer because I'm almost there. I'm 44 myself right now, so it's never too late.
It just has to fit in your schedule. My wife was working, my kids were in grade school at the time, late grade school, and it, it, it worked. I just had time, and I did an accelerated plan by taking summer school. So I got out even as a part-time student, I was out in about 2.5 years. And my last semester, I only had one class. So I was studying for the bar. And when I graduated in December, I took the bar right away in February, where most people would have waited until July to take it. And so I really accelerated the process and I passed amazingly. And it's funny, I had to this is the last thing about me. I had to write a paper. The last class I took was solo practice, and it was a pass-fail course, Jim. And you had to write a paper which included a business plan. How would you set up your business? Well, I had to go out and find an office space. I had to put together a budget. I had to talk about what I was going to do. And damn it, if I didn't pass the bar the first time. And I said, oh, where's that paper? So I had to rummage through and I pulled out my business plan and went back. And that office space was still available. So I rented that office space and I started my practice using the information from the paper I wrote. Oddly enough, very interesting.
Yeah, that's great. I think what's so interesting to me is how much you were able to accomplish in this space and so quickly. And I say quickly, I know for you it was a long time, but I think the advantage that you had, and you mentioned this, is that right out of the gate, you got started in this business. Whereas so many of us, like myself, it's more of a secondary career after doing that W-2 in a professional job, whatever it may be. And so they're seeking that opportunity to build additional streams of income. And then they decide they enjoy doing it. So then they say they want to do syndication full time. And it's a slow transition into that. But it sounds like you were all in right out of the gate. And that gave you a distinct advantage just from the speed perspective. And starting early, you were able to build that up. To hear that you had 2,000 K1s at one point is both impressive and terrifying,
Yes.
as is the number of investors that you had.
And in those days, there were no back office companies to help me like there are today. Maybe what I really should have done is gone out and invented a back office company and done that as opposed to going to law school. But no, I'm happy. And so I had been a syndicator, so I knew everything that happened in the business. And I still have that as I'm mentoring my first time clients. I'm a perfect person for a first client to come to because I know all the questions to ask and all the mistakes that you can make first time because I probably made them all or I've seen other people make them. And then I had the paperwork. I had 16 offering documents sitting there in front of me. And one of the first things I did is I created my own version of the PPM and the operating agreement. And I was ready to go immediately. And a huge marketing background in the commercial real estate industry. I taught the CCIM courses for 40 years, and I had a huge database, a huge background of people that I could immediately go out to and say, you guys knew I was in the syndication business. Hey, I just passed the bar and I'm still in the syndication business. How can I help you get started? Well, often over the years, I've had some partners and have a partnership today, and so that's been good.
Yeah, and I think that the database piece is important, whether you're starting your own law firm or whether in the syndication business, because so much of this is about relationships,
Right.
and in having those folks that you can call on, those investors, and not have this expectation of I'll find the investors when the deal comes to me. I think there's a lot of bad data out there that says, oh, if you have a good enough deal, the money will come. And it doesn't necessarily work out that way. You want to have those soft commitments, people ready and willing to invest their money when you get a deal, not the other way around.
Guy taught me when I was syndicating, a fellow who I knew who had a really big syndication company, bigger than anything I ever had, came to me and he said, I I see what you're doing. I'm following you. I'm going to give you this piece of advice. You have to sell the sizzle. I said, what do you mean there? And he said, well, the first thing you need to do is you need to build a database with people who believe in the sizzle of real estate. You don't, today I can say, I don't need people in there that invest in cryptocurrency. That's not what I want. I want a database of people who understand the sizzle of real estate. Okay, that's a start. And then he said, from there, you need to determine what is your specialty going to be? What part of the real estate industry do you know a lot about that you're going to run, and you sense that there are opportunities available for investors? In my case, it was storage facility. We were early in the game building storage facilities in Southern California, so the demand was there. The cities were acceptable and all that. And taking an approach that we were just going to build and sell helped me attract high income investors who wanted to build their net worth, not get a check every quarter to buy groceries. So I had to say, okay, I'm going to be in the storage business, and here are the opportunities I see. We're going to build a project. We're going to do 2 in every offering. We're going to diversify. We're going to get them sold. And we think we can probably double or triple your money in 3 years. That's an opportunity. Then you have to sell the sizzle of your team. Who's going to do that? I was going to raise the money and work with the investors, and my partner was going to pour concrete. He was a concrete guy and knew how to build storage facilities. We rebuilt concrete pads and concrete tilt-up walls. Then everything else was metal. And we had some managers and had a team. And so I had to sell the sizzle of my team in convincing investors that wanted real estate, wanted this part of the real estate, that I could actually capture those opportunities. And then it wasn't to sell. Then we're down to the offering. What's the sizzle of the offering? The sizzle of the offering is exactly what I thought it would be and what I told them it would be in the first 3 steps. Get out your pen and press hard. There's 4 copies. That's about it. But if the offering was exactly what I said it would be as I was building those relationships, it was an easy sell. Plus, and I know we're going to talk about 506B, I was working in those days under Rule 506. And you had to have a pre-existing and substantive relationship. So by the time I got to real estate, my field of real estate, my team, here's the offering, I was all set, ready to go. So that's what I teach. When I teach my classes, I teach sell the sizzle.
No, that's great. No, I'm definitely going to use that. And it's so, what I heard you say, you're talking about selling the sizzle, and the 3 primary things on that are the asset, the team, and the deal itself. Those are the things you want to focus
Right.
on.
And you really need to start with people who are interested in real estate. Because if you just hand them an offering, you sit alongside a guy on an airplane, you say, I sell real estate, here's an offering, it gets a 12% yield. Without any background, the guy's going to say, I get 16% per year, 22% here. You're never going to sell that way. And that's the problem. What I was doing is I was starting with the smallest part of the market that would buy from me. And then you go up to people with the team and the real estate and whatever. And so I turned the pyramid upside down. I said, let's get a real estate-based database. Let's get a group of people who like the idea of building storage. Let's show them that we've got a team. And now whoever is at the top, let's show them the offering.
Yeah. I think that gets into the different ways that people approach this business and a lot of businesses. Some people say cast a wide net and you'll catch some folks, where other people say what you're talking about, which is really the niching down, finding those people who are going to be passionate about that thing, and that they're going to invest in it. And then eventually they'll tell their friends and their family as they see success, and it'll more organically grow rather than trying to cast that wide net and hope you catch something.
Yeah. And so today, when I go through my 10 steps, the second step is building a database of 50 people that you think you have a 50% chance of raising money for the minute you bring your offering out. And depending upon what your minimum investment is, you'll go to bed at night feeling pretty good. If you had 25 people who you thought were going out of the 50 would invest 100 with you, I got $2.5 million before I even start, before I even hire the attorney to draft the documents. So if I'm going to raise $3 or $4 million, I'm on my way. And I think that's the way to do it.
Yeah. And I'm sure you've seen multiple times operators who thought they had a deal in hand, were going to raise, and then maybe that database wasn't as friendly to them as they thought, where they make assumptions that 75 or 80% of the people who are soft committed or whatever the case may be may invest, and sometimes it just simply falls short. Have you seen that once or
Oh,
twice?
sure. Now, quite honestly, in the last 4 or 5 years in this cycle, we've never had a client who hasn't filled their offering. And that's primarily multifamily. There's so much money chasing multifamily because, everyone's living in an apartment building. Not everyone has rented a storage unit or everyone has worked in a store. A great place to start as an investor is to invest in multifamily because you're somewhat familiar with it already. And there's an imbalance of supply and demand, Tim. There's more demand for housing than there is supply, and everyone understands that. There's just so much money out there flowing into projects. If you have a good database, you're anyway, and that's an ongoing process. I think what you do every single day as a syndicator is work on building your database. And if I'm a passive investor, I might want to be in 2 or 3 syndicators' databases. So I get a chance to look at multiple offerings. I think that would be great.
Yeah, and that makes sense. And it's probably doing myself a disservice to say this, but I understand and identify with that as well. As a passive investor myself, I don't only invest with one operator because for me, it's a matter of diversification, right? Diversification amongst operators or sometimes different asset classes or asset types. That way, I'm not too heavily invested into one thing that the bottom may fall out on.
Geography is important too, especially in multifamily, because, Texas has been hot because of the job growth and all the people moving to Texas. But there's some other places that are hot that I have very good operators in where the prices are a little more attractive to start with, but there's still the household formation and job growth in there. And it's good. So yeah, that's all interesting.
So you said that you got out of multifamily when you were first starting out from the syndication perspective because you didn't like the management piece, which I completely understand, especially if you're talking like houses. That's even worse. I've self-managed a triplex and I was close enough to drive to it, which I think in and of itself was a mistake because I was way too accessible. What are some of the other reasons that you made that shift to self-storage? I know there's different advantages to that asset class from, say, multifamily, for example.
Well, yeah, multifamily. And I even did a mobile home park and I ran into the same management. So one of the decisions I made is I wasn't going to manage anything long term. So now, if you're not going to do that, what are you going to do? You're going to build. That's what I saw my only option was. And I just thought, given what I was learning in the world of supply and demand in real estate, I thought the storage industry was a good place to build. And I raised a lot of money through the broker-dealer community too, for stockbrokers. And when I floated that idea to the brokers, they liked it because no one else was doing that. So I basically the exclusive provider of storage projects. And Public Storage wasn't building them. They weren't redeveloping projects. So we built properties that they bought. We I owned a lot of orange paint. And we built some things. So there was a ready market for what we were building. And you build a 600 unit self-storage facility, you have one bathroom. And the way we built it, we had a live-in manager couple on the site, total security, computer run, guarded gates. Other than the fact that other than the outside walls, everything was metal. It was a pretty much management once we got it built. And it was a great place to do cross segregation, if you would, because in a storage facility, from the roof to the doors to all the interior walls, it's all 7-year property. So you just, even before there was something called cost segregation, you could allocate your cost and just say, this is how much I paid for steel. Let's write that over 7 years. And then the rest of it is blacktop and concrete, which would be 39 years at the time. It offered some advantages.
Yeah. And I know some people who are doing it now and doing it very successfully. So there's still an opportunity there. It probably depends on market because some places are certainly getting saturated, as does happen. But
yeah, I always thought that I always feared that the last person who needed to store their extra mattresses or their Ski-Doo or whatever had just rented somewhere else and was going to build this project, and all the demand was taken. The houses are smaller. Not everyone has a garage. So where are you going to put your stuff? So anyhow, that's it.
yeah. And so I want to move over to the syndication side where you levy your expertise on behalf of clients. And so my partners and I have done several traditional 506B and 506C offerings. But like many in the space, we want to make those opportunities available to as many people as possible. Can you talk to us a little bit about crowdfunding as a means of raising funds and what the pros and cons of that might be?
Okay. You used a word that has a specific meaning in the law. When the Jobs Act in 2012 came along, they passed a regulation that's called crowdfunding regulation. And we refer to it as CF, regulation CF. It's a specific part of the Jobs Act. And at the beginning, what it says is, hey, you can advertise, you can raise up to $1 million a year, and you need a broker dealer to have a crowdfunding portal to raise your money for you. And so it went on. Crowdfunding has been around. I always say that the earliest example of crowdfunding I found was when they brought the Statue of Liberty over to the United States. The government didn't have enough money to install it. So they went on the radio and they went on the newspaper and asked people to send them their dimes and their nickels and their dollars, and they raised enough money to install it. That was crowdfunding. Okay. And there's been donative, that would be the word, you're just giving the money with no expectation of any return. There's been donative crowdfunding forever. There still is. You hear people on the website, hey, I need my teeth fixed. Or you hear of some disaster, someone's died, and the neighbors have put together a crowdfunding. Okay. That's all fine, but you could never do that in our business where people are looking to make a profit. So in 2012, the Jobs Act came along and said, okay, you can do crowdfunding. Because what's a security? A security is when there's an expectation of profit. Okay. That's one of the full parts. And so go ahead, if you're going to raise $1 million and put it to work and promise people that they're going to make a profit, you got a security, and we're going to say that's okay. And so it started out, and still the most common crowdfunding under regulation CF situation is private label beer. People start in the basement and they make some IPA, and they want a larger facility, and bigger pots and pans and stuff. So they raised money to do that. So that went along for a long time, never applicable really to real estate because of the limited amount of money we could raise. Then a couple of years ago, they raised the limit to 5 million. Now we're talking. Now you could advertise and take accredited and sophisticated investors in, and you could raise up to 5 million. You still have to go through the portal, the funding portal, and which in itself is the problem. Most of the crowdfunding portals today, and I think there's an opportunity for someone to develop a crowdfunding portal for real estate, but most of the crowdfunding portals don't like real estate because the asset is not liquid. The holding periods are too long. And the broker dealers who are selling want to sell, they want to churn money. So they don't do real estate. So we do beer and we've done sake and we've done some education products, some medical products, for people raising money for a patent, things like that. But we've never yet been able to do crowdfunding under Regulation CF for real estate. And like I said, someone needs to get out there and become a broker dealer and be a place for real estate investors to go. But we haven't seen that yet. So that's it. But that word got usurped by everyone. My book is called Crowdfunding, and Syndication Crowdfunding Workshops are syndication and crowdfunding because everyone thinks if you're advertising primarily, you're crowdfunding. Not technically, you're doing it through a 506C, which isn't crowdfunding per se, but all the securities platforms that are out are called crowdfunding platforms. A Real CrowdStreet, Realty Mogul, they all say that they're working on crowdfunding. Oh, they really aren't. They're working on syndication under the securities laws, but that's a really popular word. Tim, my feeling is to go down the path of doing a $5 million crowdfunding offering. You better make sure before you start that you have a funding portal who will take your offering. You can't raise your own money for that. Everything has to go through the portal, which is exciting if they'll do it for you, but not exciting if they won't take your offer. So it's much easier to do a 506B and raise the money yourself. Much easier and cheaper, much cheaper.
That was the other piece I was going to get to. I know that it's cheaper with just some of the research that my partners have done. So I think a lot of this came about because we saw people like Grant Cardone who are on TV saying, hey, or YouTube or whatever, saying, we'll take $500 towards this 300 unit Class A apartment in Miami. What, and I'm not sure if he's a client or not, but what
yes,
is
we did his, the firm I was with at the time did Grant's first Regulation A+ offering, and he did market it as a crowdfunding offering, and it isn't. It was Regulation A+, and it has its specific securities rules to it. At the time he did it, the maximum was 50 million. Now on an A+, you can do 75 million. Accredited investors, non-accredited investors, but there's some net worth requirements. And so you can do $500 or 5,000 as a minimum. Yeah. We were with him when he did his first event after he had the documents in. It was at Mandalay Bay, and he had 13,000 people in the auditorium, and people were walking down the aisle handing out information sheets. And if you were interested in it, fill it out and they would contact you and they'd sell. It was totally legal under Regulation A+.
Now, I've never heard of Regulation A+. Is that something that's very specialized and I'm assuming quite expensive to structure?
Regulation A has been around a long time, but it wasn't practical because you could only raise $5 million. So in the Jobs Act, they brought Regulation A, and then they brought A+. A was for 25 million and A plus was 50 million, and everyone goes to A plus. It costs you $200,000 to get that done. Probably takes 6 months, because even though it's not fully registered with the SEC, they do look at all the documents. They question your projections. They give you a permit to sell. You have to do audited financial statements. So they're involved in your offering. It's the closest thing to having a fully registered offering in a SEC, but a fully registered offering is even more expensive and more timely. So you do a couple rate A's a year. They're all blind pools, Tim. You'd have to have a track record or you wouldn't raise money. And we did one on a liquor distributor came out with a new brand of liquor and wanted to expand their distribution network and production network, and that was good. A couple of real estate, we did one on a company they didn't want to raise 50, but they did with A plus, and they wanted to raise money to buy surgical centers, the blind pool of surgical centers, and they had a track record of managing surgical centers. But the deal about A plus, the only thing attractive about A plus is you can advertise to non-accredited investors. If you go to 506C, which I think we'll talk about, you can advertise, but there's no limit to how much you can raise. A plus is 75 million. Regulation 506C, there's no limit. You can advertise, but you can only take accredited investors. So that's the deal. If someone calls to me and says, I want to raise $80 million and I want to take non-accredited investors, I tell them there's no game. There's no game in town, because Reg A is only 75. They want to advertise and take in non-accredited investors and raise $80 million. There's no game. Nothing available to you. You have to scale back unless you want to go to the SEC.
Yeah. And I think that's why a lot of syndicators naturally start out doing more 506B deals, so that they can get those folks that are within their immediate circle who may not be accredited, but they want to get them into those deals. But then a lot of them seem to naturally progress into exclusively doing 506C because it's more lucrative. And then at that point, they have that database of investors who are willing to invest, and they're not as concerned with having the numbers, as it were.
How has your experience been in 506, the 506Cs you've done?
So I think it's always challenging. Again, especially for me starting out, I didn't have that Rolodex of accredited investors. Most of my immediate circle were not accredited. And those are like those 50 people that you talked about at the beginning of the show. Those are the people that you're going to go to first. But then as you gain more of a reputation, you do more deals, then more people start to come to you. And depending on how you're targeting through advertising, word of mouth, whatever, you start to get more of those accredited investors. And then I think there's an inflection point where you have enough accredited investors within your database that you can rely on them versus having to do the 506B. I don't know if that's been the experience of others, but that's what I'm hoping to get to at some point. And because of the advantages associated, like you said, with the ability to advertise, no limit, et cetera.
Good. That's your experience. That's interesting to hear. My most prolific syndicator, Tim, since 2014, when he became my client, has done 164 offerings with me. All 506B, accredited investors only, no advertising. And right now his investor list is frozen. He's not taking any new investors. Why? He likes rich and smart people to invest in his deals. I think he found somewhere along the line that non-accredited investors might be the most cumbersome to deal with. Okay, could be right. And 506B, an accredited investor only has to check the box that says accredited investors is one of these 11 things, which are you check the box and you don't have to have any more research. Where you go to 506C is you have to have some third-party verification. And once people start investing with my clients, checking the box, they're not necessarily interested in going over to a C, giving up tax returns and financial statements and all that. So I think that's a barrier. I'll give you some statistics. The last numbers that the SEC printed out, they're almost a year old because they print them every year. They produce them every March. Said that the private placement market is $2.2 trillion, bigger than the IPO market on Wall Street. And that's all it's Regulation D and it's Regulation A is what it is. But 95% of the money of 2.2 trillion is raised in 506B. 3% is raised in 506C. And 2% is raised in Regulation A. And the reason for that imbalance is that the broker-dealer community doesn't need to advertise. The broker-dealer community is having seminars and the wisdom of having an estate plan or a financial plan, and they meet with their people. They get a relationship with their people. They put them in the Rolodex. They've got more people than they know what to do with. And most of the money is raised through the broker-dealer community. It's just us little guys who might go into 506C and 506B. So 506B is the game.
Yeah. Obviously, you knew that I was going to ask the question why, so you preempted it there. But now that you explained it, it absolutely makes sense. You're just removing a barrier for those investors. May be a minor annoyance and maybe a $35 charge for that third-party verification, but it's another hurdle that they have to go over and something that they may not want to do. So why bother putting that hurdle there if you know they want to invest anyways?
My investors who do go to 506C, and we've had quite a few, are doing it because it's time to build their database. It's time to do advertising, get people out there who will come to them and say, give me more information. And then through the interviewing process, they find out that the person is not accredited. So they put them in their database, build a relationship with them, and then take the next 506B deal to their new expanded database. That's really what it is. Now, have you heard of it combining a 506B and a 506C?
Yeah, that's where I was going to go next. It seems like the best of both worlds, and I know a bit about it, but I'll let you speak to it.
Okay. When I write the PPM for my clients, I say, we're going to start out in 506B. And at some point of time, at our option, if we want to switch to a 506C, we will tell everyone. Okay. During the 506B, you have to have a pre-existing substantive relationship, and you can take your non-accredited investors in. Once you switch to 506C, you can advertise, and you can only take accredited investors where you don't have to have a pre-existing relationship. So how do I do that mechanically? At the time that the sponsor, let's say they want to raise 5 million, raise 3.5, and they've gone through their database. They say, okay, we want to switch. So what I do is I send a Form D to the SEC and say that 506B offering is closed. Then I send a Form D to the SEC and say, we are now opening the 506C offering. So there's a definite stop, and we're telling the SEC what we're doing. And from then on, you go forward and try to raise the rest of the money, try to build your database. And then when you're through raising money, you send that 506C offering is closed.
Yeah. And I think it's really important people understand that. And I'll say that it's new, but it's more new-ish. It's been around for a little bit, but it doesn't seem that a lot of people were doing it, but it's starting to gain more traction. Is that your feel for it?
Yes. One of the things I feel about the market today, Tim, is a lot of investors that you have are tapped out. They've invested a lot over the last 4 or 5 years, and you've either exchanged into a new property, which doesn't free up any money, and they don't have any more money. So you may very well have to find some new clients with some fresh money. And that's where it makes sense. Because I am finding we do a lot of 1031 exchange and the tenant in commons exchanging up, and investors will, the syndicator will have to raise. And last one I think we did, they needed 13 million to close the deal, and the equity out of the old property was 10. So they put that in together, and then they went to 506C for the other three so they could attract new investors and build their database. The whole investing, I think, in raising money of 506C is your track record. Who's going to send you $100,000 check if they don't know you and this is your first deal in whatever space you're in? Good luck. It's not illegal, but it's a marketing question.
Absolutely. I can identify with that struggle. We've all been new investors at some point, new syndicators at some point. And I think that's really when you have to lean on the experience of the team that you're working with, which again goes back to selling the sizzle on the team.
The team, right? You got to do that.
So this has been amazing. I want to get into one of these other questions, though, that I know is going to resonate with a lot of people listening here. And obviously, securities law is very complicated, which is why we go to smart people like you to keep us out of trouble. One area where I still see a lot of confusion and, frankly, a lot of missteps is putting details of a 506B deal out there on social media. Can you tell us some of the biggest mistakes you see there and some advice so we don't run afoul of the SEC?
SEC came out with a paper, it was a long time ago, 2002, that talked about this issue. And it was really addressed at the time that we were doing a lot of tenant in common deals. And the brokers were interested in finding people who had real estate who'd like to exchange. So how do you find those people in a 506B offering? Because a tenant in common offering is a security. So how do you find those people? So they came out with three, it was about a 10-page article, and it came out with three basic points. Generic advertising is fine. Why would you consider investing in multifamily? Supply and demand, household formations in your market. Amazon is building a big factory over here, and there's been bringing a lot of jobs. It's a great idea. If you're interested, to contact us. Generic. Don't say a thing about I've done it, I'm going to do it, I'm doing it now. Just generic. Then it says you cannot sell a security through advertising talk about a contemplated or current offering. That's just the rule. Okay. So if you're on social media and you're talking about a current offering, you're violating the 506B rule. Remember, every security has to be registered with the SEC unless it's exempt under some rule. And 506B is an exemption rule. If you follow the rules in 506B, you don't have to register with the SEC. If you don't follow the rule, you blow your exemption and you get sued for selling an unregistered security. Big trouble. Okay. No advertising or solicitations for a contemplated offering or a current offering. And number three, you need a record-keeping system to show, if you're ever audited, the date that you come across a new client and what did they invest in. Okay. So it's whatever today is, I've got an offering out there and I come across you respond to my generic advertising, okay, which is fine. And I respond to my generic advertising and I sell you the deal I have today. That's going to be trouble. The rule is I can sell you the next deal, but not this deal? The answer to your question is simple. With all the people who are out there talking about their current deals, that's trouble. One of the other things that's trouble is the SEC takes a position that on your previous deals, all your investors know the results. Who's invested with you in that deal knows what happened. So anytime you put your track record out there, you must be doing it to attract new investors. And so I guess you can do that and they can come into your database, but you can't sell them anything until the next deal. Okay. So putting your track record out there is a mistake. And the one that I love today is the picture of the monument sign for Whispering Hills Apartments and 20 investors standing around with the sponsor saying, hey, we just closed this deal. Our expectation is a 6% preferred return and a 15% over 5 years. Why don't you call us if you'd like to know about our next deal? Okay. So remember, it's no advertising or solicitation for a contemplated offering or a current offering. So they say that's conditioning the market for your next offering because you're telling people about your deal. And all those 20 people in the picture, they know. So why are you putting that on the website? Only to get new people. And that's the philosophy. If you're ever audited behind the SEC, all your people know this stuff. Why would you be doing that? To find new clients. Okay, let's look at your record keeping system and make sure that when you get a new client, you can prove, you can track it, that they didn't invest until the next deal.
Yeah. And I think that's where good record keeping comes into play. And as you move up in your professionalization, you should have that CRM, whether it's Active Campaign or an Excel spreadsheet that tracks these folks, first contact with them, when their first investment is. That way, God forbid, you do get audited or some investigation comes up, you have some way to show when that happened.
That's the third bullet point. Generic advertising is okay. No advertising or solicitation for contemplated or current offerings and a record keeping system. Those are the 3 rules. And I used a software called ACT. And when let's say you came to me and I'm going to put you in my database, there's a field in ACT that tells me the date that I created that contact. And there's my proof right there.
Yeah. And I think that the piece that you just touched on for a bit there is certainly the gray area where people get a little confused. And so that's why it's probably best, some say, to just stick with the education piece, right? To say, hey, I'm throwing content out here because I want to educate you as passive investors. And hopefully you'll bring some folks into the fold. They'll ask you more questions, be curious. But that if you stick to that, it's really hard to get yourself in trouble. But I've certainly seen some more, I don't want to say blatant, but
You blatant like they do. Other people do it. Okay, so I always bring up the fact that you're driving 80 miles down the street and you get a ticket and you come home and you show your parents and you say, I was drag racing, other people were doing it. And your mom would say, just because other people are doing it doesn't mean you should do it. And so I think you have a problem there. And I guess in all honesty, the chances of you getting audited for something like that, if your deal goes good, are minimal. But the minute your deal goes bad, they're going to sue you for selling an unregistered security. And they're going to pick any of about 6 different things that you can do to blow your exemption. And if you've blown your exemption, then you're in real trouble. So you don't want to do that. And some of my better clients have one of 2 policies. If they're doing something generic on the website and someone contacts them, there's someone in the office that calls them and starts an interviewing process. Okay. You need some way to prove that this is the date that you started talking to them. So you prove your pre-existing relationship. And then you need some proof that you can go ahead and create the substantive relationship. Then I have other people who, after you've read the generic stuff, if you're interested, they have a questionnaire. When you push the button, up pops a questionnaire. And if you're willing to fill out the questionnaire and submit it to them, then someone from the company would call. And I really like that idea because you have this questionnaire with the signature on it, even if it's electronic signature with the date, there's your record keeping system. And I think it's a sales tool. If they don't fill it out, they're not interested. They go on to someone else. But if they fill it out, boom, that's a sales tool. So that's great.
Yeah. And I would say probably your final advice on that would be when in doubt, call your lawyer. Right?
Oh, absolutely. And I'm afraid, in all honesty, that there's all sorts of different advice coming from attorneys out there. And that's too bad. I'm a conservative attorney and I'm very interested in protecting my clients. So I'm going to give you conservative advice. You're going to make a business decision, weighing all the options on what you do. Okay. But I'm going to give you conservative advice.
Yeah. And hopefully people were listening and paying attention to all that because it was certainly valuable. Right now, we need to move on to the turbo round.
Okay.
All right. So I'm going to ask you 3 questions in quick succession. I want you to give me your honest feedback. And these are questions we ask every guest. The first one is, what is one red flag every investor should look out for? And that can be passive or active.
The first question an investor should ask is, Tim, I'm ready to give you my $50,000 and invest in your deal, but I want to know what happens if something happens to you. So the very first red flag, is there continuity in the manager? You've got to have continuity, and it isn't a continuity that you're comfortable with. I have a lot of people say, my wife. That's right. Your wife may be smarter than you and know more about real estate than you do, but in my world, she was a school teacher. So that would never have gotten past the due diligence and the broker-dealer community. So I have to have some continuity plans. That's it. That's the number one thing.
All right. Next question. What is a myth about this business that you would like to set straight?
There is no exception to the securities laws for an offering of friends and family. If you're managing the money, if they're passive and you're active, it's a security.
Good to know. All right. And the last question, what does success look like to you?
Success to me is successful mentoring. Now, today, when I'm helping people in this business, I try to get every month one new client for every 3 repeat deals I do, because I want to help people get in the business. So my success is mentoring people and seeing them through their first deal.
Oh, that's great. All right, G. Hey, this has been amazing. Please tell our guests how they can get a hold of you and if you have anything else that you'd like to share with them.
No, I think getting a hold of me probably is to go to my website, trowbridgelawgroup.com, and sign up for a free consultation. Or at my website, you can actually sign up and get a free PDF of my book. It's a Whole New Business, and the 4th edition is out now. That's good. We have a great YouTube channel with a lot of educational stuff, interviews of clients and whatever. It's YouTube, Trowbridge Law, or you can call the office at 951-570-1507. That's 951-570-1507, and they'll put you through to me.
Awesome. Thanks again, G. We'll definitely have all that information in the show notes. I certainly appreciate you coming on and look forward to seeing you do big things on your journey on Multifamily Millions.
Thanks, Tim. Good luck to you. Bye.
Thank you, you too.